India Inc Boardroom. I'm Maloney Hunt. Today we dive into ESG. We will look at what is the economic value of embracing sustainability. What are the new innovative models that address climate change and ESG investing? In another session, we will look at the future of electric mobility. A shout out to Commercify, who is our associate partner, and global management consulting firm Bain & Company, who is our knowledge partner.
Thanks, and welcome everyone to today's panel discussion. My name is Prashant Sareen. I'm a partner with Bain & Company, and your moderator for today's panel discussion on the economic value of sustainability. With increasing regulatory, investor, and customer pressure, awareness and agency on ESG, and the environment in particular, expectations for corporates expectedly are on the rise. The need of the hour is for companies to walk the talk, to go beyond addressing the issue, to take real actions, in particular, adopt sustainable practices, not just for themselves, but across their entire value chain. We believe that this can be characterized along two axes. The first one is around risk mitigation or value preservation. The second, new opportunities, new industries that are being created every day, every hour at this point, as these disruptions really take place and lead to value creation. However, this won't happen by itself, and there will need to be significant investment that takes place along both of these axes of value preservation and value creation. Despite the enthusiasm and the actions post COP26 in Glasgow, we know for many corporates there remains a long way to go. For instance, in the US, until recently, only 1 in 4 S&P 500 companies failed to disclose significant oversight on ESG, and only 7% codified it as a full board responsibility. We also know that the recent events with the Russia-Ukraine crisis are having a mixed impact, with longer-term move around thinking about energy independence and green renewables, particularly on the European continent, but also the near-term impacts, so reviving perhaps many legacy fossil fuel assets in order to mitigate the short-term rise in price in oil and gas. India, of course, represents a fascinating case as always, and we do have a lot more to do across many metrics of environmental sustainability. However, we've at the same time witnessed the fastest growth in renewable energy capacity amongst all large economies, with a slew of investments coming in, powered by regulation, utility scale economics, and investor interest. Finally, with India's fast growth and transition to net zero over time, there will be the opportunity to create over 50 million jobs, $1 trillion in economic value by 2030, and perhaps as much as $15 trillion by 2070. With this context, I'm delighted to introduce you to our distinguished panel today, different stakeholders who represent and embody different voices. First, Cyril Shroff, Managing Partner, Cyril Amarchand Mangaldas, one of India's most eminent corporate lawyers. Mukund Rajan, Chairman eCube Investment Advisors and co-author of the recently launched Outlast, How ESG Can Benefit Your Business. And Anirban Ghosh, Chief Sustainability Officer of the Mahindra Group and one of corporate India's leading voices on sustainability. Welcome. With that, maybe Cyril, I'll love to pull you into the conversation, get you to kick things off. Any opening comments from your side on this topic around sustainability, and particularly as we dive deeper today on environmental sustainability?
So Prashant, firstly, thank you for having me here. And I echo a lot of what you said in your introductory remarks. So as I see it as a corporate practitioner, that there is a significant awareness of ESG themes. What till a few years ago was essentially the corporate governance theme dominating it on a standalone basis, the G aspect of ESG has now evolved and effectively upgraded itself to a broader ESG conversation. Now, apart from the markets where investors, customers, and even debt providers have a say, there has also been sort of a regulatory push on this for quite some time. The first basic push started in the 2013 Companies Act on effectively moving us to a stakeholder model of governance, where we decisively as a nation moved away from a purely shareholder model of governance to a stakeholder model of governance by adopting Section 166, which kind of legislatively mandated that the board responsibility is to all stakeholders and not merely to the shareholders. At a public markets level and at a sort of Ministry of Corporate Affairs level, there have been many iterations, but the most recent one is the BRSR, which is 11 days old in terms of its mandatory applicability, which essentially puts a reporting obligation, sustainability reporting obligation on the top 1,000 companies by market cap. And it's a very nuanced, fairly detailed and well-considered document, which I think is certainly going to change the paradigm on disclosures. Ironically enough, I think we are also seeing movement from the judiciary. So in 2021, we saw the Supreme Court actually intervene and interpret Section 166 to make it a kind of a board obligation and a kind of a mandatory thing rather than just a good to have fuzzy thing as well. So it is, these things actually come and take effect only when they are enforceable. And I think the judiciary has started to play ball as well. A lot of work still to be done. We're also seeing new regulations come in, whether it is RBI evolving policies for green finance, what we are seeing in terms of thinking in relation to a new battery swap policy. And, this all work in progress. But these are more broader regulatory and policy initiatives which are work in progress. And I think they're going to have a deep impact. The COP26 commitments, while 2070 may seem far, and it is far, the fact that we have promised 50% by 2030 is just 8 years round the corner, and that is quite quick. It's not insignificant at all, and that's a huge energy transition which needs to be made. Before I conclude my opening remarks, I just like to sort of make a few comments about the S aspect, the social aspect of ESG as well. So it's largely been the governance and G aspect which has dominated the conversations. E and climate have now started in the last couple of years to be the dominant theme. So we should not forget S, and it should not remain too far behind. And I don't know whether you picked up this a couple of days ago. One of the judges of the Supreme Court actually made a remark that the S aspect of ESG needs a lot of consideration. There is going to be a lot of judicial interpretation over there because several segments of the labor force in the new economy, so to speak, are completely unprotected. So I think we're going to see both regulatory as well as a judicial push on the S aspect as well. And I think it's important that all three, even if they can't move in complete tandem, should move generally at a similar pace. So I'll reserve my further comments for the Q&A, but I thought this as a opening sort of both legal / policy setting by me should be okay.
No, thanks, Cyril, and thanks for sharing some of the regulatory backdrop and the fast changes that have been taking place. I think 2 points in particular resonate. One is this notion of citizenship that you highlight, particularly as the Supreme Court is taking this view, not just shareholders, but stakeholders, which is a much more expansive view. And perhaps linked to that also is this notion of disproportionate equity or equality, particularly as we think about the underprivileged. And you think about some of the changes, especially the environmental changes that are causing significant challenges in natural habitats around the world. And as we see some of the challenges, even in Delhi, with temperatures far in excess of what you would expect in early April, those impacts will be felt much more by the underprivileged, and thinking about that is also quite critical. Anirban, opening comments from your side?
Every time I hear a new way of looking at this subject of sustainability, like the one you shared, value preservation and value creation, I tend to go back to the sustainability definition that we use in the Mahindra Group to see, hey, have we thought about it at all? So let me first share the definition that we use. It is about building enduring business by rejuvenating the environment and enabling stakeholders to rise. It appears to me that aspects of value preservation and value creation are probably embedded here. When it comes to value preservation, which was your first area that you wanted to explore, Prashant, to my mind, there are three things that corporations do. One, of course, is compliance. Second is risk mitigation. And because of the impacts of climate change, there is the area of adaptation, which is very, very crucial. So if we were to ensure that the organization at least complies to all climate-related regulation, manages climate-related risk, and does sufficient work in the adaptation space to make sure that all the risks that are happening because of climate change don't come and hit us very badly, we would have done reasonably well in value preservation. Now, the compliance bit is dealt with well, thanks to the focus on governance, but at least by large organizations. The climate risk piece, I think clarity on that is only just emerging. I don't know how many organizations have figured out the different kinds of risk, either new or accentuated, that they are likely to face because of climate change. And these changes are going to be very, very large. Just to take one example, every time we have a monsoon which is not well spread out, and maybe doesn't reach the northwestern parts of our country where most of our food is grown, we are, comfortable knowing that the melting glaciers and perennial rivers will make sure that water will continue to be available. So a bad monsoon in the northwestern part of our country has not had a very bad effect on crop production. However, with climate change, if the glaciers start receding, then the availability of water would start becoming a very big question, and we could face a food security situation going forward. Now, how that can then snowball into various kinds of risks for different businesses across the country is something that we need to look at in far greater detail. So compliance, yes. Understanding risks, clarity has to increase a lot more. Adaptation, I don't think we've even started. Because if we don't understand the risks well enough, I don't know what adaptation actions we are going to take. And if you were to ask anybody, okay, so what are the adaptation actions required? I guess we'll first start with flooding, but we'll have to go way beyond that because productivity decreases thanks to increasing temperature is going to hurt industries like construction, agriculture, and any other industry where you have a lot of workers working outside and not in air-conditioned offices. In fact, the effect of increased air conditioning on climate change we are all aware about, and that too can have another cycle of risks and the need to mitigate and the need to adapt. So let me conclude right now by saying that an approach to building an enduring business by rejuvenating the environment and enabling stakeholders to rise could address both issues of value preservation and value creation. While compliance is something that larger organizations are doing well and can be expected to do well because of their focus on governance, we've only just got started on understanding climate risks to business, and we need to get started on adaptation actions to make sure that we don't get hit by climate risks.
Thanks, Anirban. And I loved your laying out of the three elements: compliance, risk mitigation, adaptation, and just focusing and walking us through how different companies are thinking through them. A lot more to be done on adaptation for sure. Mukund, turning over to you, opening remarks from your side.
Sure. Thanks so much, Prashant. You mentioned my book, Outlast, and the reason we gave it that title is my co-author and I felt that really Indian businesses today are at a very early stage of their evolution on the ESG curve. And yet the ones that are far-seeing are doing a lot about this, including Anirban's group, for instance. And those are likely to be the ones that will outperform the competition and indeed outlast for the future. We also make the assertion in the book that really the kind of focus that ESG and sustainability is now getting in India, I think requires that businesses across the spectrum give it the same kind of attention, which was perhaps given in 1991 when economic reforms and liberalization were introduced in this country. And I think it's critical that Indian businesses understand the kinds of expectations that stakeholders have both in India and overseas, and will have increasingly in the future with much higher standards expected. Now, I've just come from a weekend conference with a bunch of private equity and venture capital firms and some companies that are represented there. And I think the conversations there clearly confirm this view that we are still at a very early stage of evolution in India in terms of the way we think about sustainability and ESG, and especially when you compare it with perhaps what is taking place in markets like the European Union and now increasingly the United States. Cyril talked about a number of pressures that are beginning to come in India from the regulators, from the government, and indeed incentives. Think about the PLI program, the famed scheme, faster adoption of manufacturing and hybrid and electric vehicles and so on. The judiciary is taking a strong look at sustainability issues and deciding questions on behalf of the public interest and civil society, and of course, customers, including Gen Z. But still, I think all of this tantamounts to relatively less sort of pressure on Indian businesses to change faster. Currently, my sense, and this is a personal view, of course, is that a lot more of the pressure at this point of time is coming really from overseas stakeholders, in particular foreign investors and foreign multinationals, of which Indian companies form part of the supply chain. And these companies are now being asked to adhere to high standards that are relevant perhaps in overseas markets. But for Indian businesses, I think in the Indian market, perhaps with the exception of large companies like the Mahindras, for instance, and perhaps companies that have a strong export footprint and therefore are aware of trends overseas, the large percentage of businesses across India, I think, are still relatively low in their awareness of how quickly this landscape is changing in other parts of the world and how important ESG and sustainability will be to their future success. Another phenomenon one tends to see is that for many companies, really they equate doing better on sustainability with doing better simply on environmental compliance. And I think the S and the G tend to be given less importance sometimes. And within environment, again, it often boils down to a question of cost. Especially if you come from a manufacturing background, then what is it going to take in terms of capital allocation for me to do better on my environmental compliance? And if there is a way one can avoid it or delay it, that tends to be the preferred strategy just now. Particularly in the light of COVID and other pressures that companies are facing, there is an effort to try and keep costs down as much as possible and a reluctance to allocate capital towards doing better in ESG right now. But I think that's beginning to change with some of the forward-looking companies. But just now, I'd say it's a little bit of a mixed picture in India, and I think businesses on the whole have a long way to go.
Thanks, Mukund. You resonate a lot with what you said. I think two elements in particular that stand out for me. One is this notion, you talked about the importance of ESG and sustainability, similar to the reforms that took place in 91, 92. I almost feel like the language and the vocabulary is similar to the way we think about financial metrics, the robustness of financial metrics used today, the scrutiny and the legality of it. A lot of that needs to come to the ESG domain as well, with the same metrics, the same rigor. the same transparency and analyses, especially given the link to long-lasting, enduring organizations. And that piece resonates a lot, as well as you mentioned a weekend conference with private equity investors. In our work with private equity investors, we're seeing more and more of them double down and do an ESG diligence as well, in addition to a lot of the other diligences they earlier did on the asset. Again, with this notion of making sure that when you take an equity position, that when you exit, you take an equity position in a company that not only is going to last and be robust from a financial perspective, but also an ESG perspective, because that's going to be so important to getting a higher exit multiple. I did want to come back to each one of you on these themes of around value preservation, around risk mitigation, and I'll pull in from the comments that you had. Anirban, I'll come first to you. You spoke through the Mahindra Group's philosophy, and thanks for that. It's very eloquent. And I'd love to get your thoughts on one or two key initiatives that you've launched from an environmental perspective that you think will have a real impact going forward.
So, Prashant, the first thing that we started on was deep decarbonization. It was possible to get that started. Technologies were available. And it was addressing the biggest problem that was facing the earth from an E perspective, and that is, reduction of emissions. Luckily, the deep decarbonization solutions were actually great for business from a cost reduction point of view, and so we were able to scale. An investment of upwards of 250 crores over the last 5 or 6 years has created an annuity savings stream of 145 crores per year.
Wow.
Numbers like this, financial people love. So the question is not balance of sustainability and business. It is how much more of this can we do? And this is actually the reason why I believe that we will find many solutions, because and we will be able to address the climate issue, because a lot of the technologies are economically viable. So deep decarbonization includes energy efficiency work and renewable energy work in broad terms. And, that's self-explanatory in itself. But that's not the only thing that we knew we had to do. We looked at what are the ways in which a business needs natural resources to do business, and how do you ensure that you don't have a negative impact? In short, how do you try and become planet positive? So one important area is the use of water and the discharge of effluents. So the group decided that it wanted to be water positive, and discovered that being water positive through community water harnessing is not very difficult at all. But if you were to have a water shortage at a factory location, it may not be of much help. So we've worked very hard on increasing water productivity, a term that is not very common. And as a result of that, there are locations in the group today that don't need to access water from the municipality for more than 200 days of the year. We will try and maximize this to the extent possible at whichever location is possible. Recycling of water has already reached 45-50% levels at our factories, and we are looking to reduce the freshwater intake through tankers at each one of our resorts and make them greener as we go forward. One way in which businesses actually harm the environment is the way in which wastes are disposed of, even if you are following the rules of the Pollution Control Board. So we've taken a program on which is very simply ensure no waste to landfill. When we started the program, I'm not sure we knew what to do, but over time we've discovered that there are ways to reuse, repurpose, and ensure that the waste does not reach landfill. 25 of our locations are now certified as being zero waste to landfill, including the integrated city that we have in Chennai. And lastly, we recognize that whatever you do, there will be some emissions that you will cause, and there will be some pollution that you will cause. So we've got a program to promote biodiversity and help nature help ourselves. There are 20 million trees that are growing right now, planted by the Mahindra Group. The run rate is about 1 million odd trees per year, and we are looking forward to scale it up to 5 million trees per year by 2026. So these are some of the initiatives. Okay, so while I'm telling you trees, it sounds simple enough, but if you plant 15 million trees in a particular area, the ecosystem it creates for flora and fauna is something that I don't think as human beings we'll ever be able to create ourselves. So that's why we call this work in biodiversity as helping nature help herself. So these are some of the initiatives we've taken up. There are many more, but broadly, these are the 4 big ones that have very high impact in taking us towards becoming planet positive.
Anirban, thanks for that really impressive set of initiatives. And I love the last one on promoting biodiversity. And of course, the impact it'll have from a greenhouse gas emission perspective and acting as a carbon sink. So, Cyril, I wanted to come to you, and you talked about BRSR. We're in the first 11 days. How do you envisage from your conversations with chairmen and CEOs across the corporate landscape, how do you envisage the impact of BRSR? And as we move from voluntary disclosure now to mandatory disclosure of the top 1,000 publicly listed companies in India, what do you think will happen, and what more needs to happen in order for us to realize the vision that perhaps Anirban was painting for us?
So on a lighter note, not all chairmen and CEOs know about the fact that this rule has come in. It's the chief sustainability officers and the secretarial and finance departments who kind of keep track of this, because they are facing the stock exchanges and others. So I've had occasions speaking to some chairmen and CEOs, and they said, like, what is BRSR? But hopefully that phase will go soon, because I think the independent directors on the board are also going to be asking this question at board meetings. So the big risk I see on BRSR at the moment, though I think it will change, is that it can become just a tick the box operation. And that's how a lot of consultants are also selling the story about, we'll do this for you for 5 lakhs and 6 lakhs, and others where they'll send a question and somebody will tick 15 boxes, and that's the end of it. So there is a risk that it becomes a part of a compliance function. But the real story on this is that it is actually a strategic function. It needs to be forcing boards and managements to think about ESG from a more strategic mainstream perspective. And many groups have done that. I find that in some groups, the sustainability officer or the ESG person is actually sitting in the chairman's office, or is sitting in the strategy office. So those folks have understood the difference and have kind of are dealing with it for what is really supposed to be. So from a risk point of view, I think there are 2 or 3 things. One risk, I think, is, and I think both Mukund and Anirban talked about it, is a risk of missing the bus. So if you don't catch this theme and you just think about, I'll just, fool around with a little bit of engineering and come in compliance, and I'll make some disclosures and all of that, the big risk that you run is that you may miss the entire opportunity of reinventing yourselves and find out that, 5 or 10 years from now, you have become irrelevant. I think that is actually the biggest risk. The second is a kind of more short-term, more here and now thing, which is of legal liability, whether it is something which arises out of the disclosure that you made, or some NGT order that you violated, or some Air Act, Water Act permission that you have not complied with, and those kind of which are more here and now. They are easier to get your kind of hands around, but the embedded long-term risk is of climate action. We are seeing this happen in Europe. I mean, we've all been following the Shell story. We've been following stories in the United States, thanks to effectively class actions based on activist investors as well. Those are, I think, the medium term, and there can be real liability. Now, India doesn't have, in a meaningful way, class actions, but I actually think that we are one judicial innovation away from it. It just takes one activist judge in the Supreme Court to just sort of, stretch the boundaries a little bit, and that will open a floodgate of climate litigation, especially since the foundation has been laid in Section 166 of the Companies Act, and there is some sort of a climate act, a class action framework in the Companies Act. So it's kind of, the forest is dry and it's not being one match to light it. And I think that is, I mean, again, I was not using a climate analogy.
No pun intended.
Yeah, no pun intended. So that's where I see this. So, directors sitting on the board, and especially, independent directors on the board, should be asking piercing questions on this. And they have started. To be fair, I think they have started asking this, and the curve, the knowledge curve and awareness curve is rising sharply. It's not 100%, but it's rising.
So, Cyril, thanks for that. I think the notion both of irrelevance, which is what Mukund alluded to in the beginning of building a truly enduring company, but I think there's a little bit of this shorter term push around, legal liability, both acting in concert, I think will make a real difference. But let me pull a little bit more on that vein, Mukund, and you highlighted where India was on the spectrum and mentioned that, in effect, as you've looked at a number of different metrics, there is the beginnings, but clearly a lot more to do and a real journey that we need to traverse. And as you compare India today versus a number of other developed economies, and you're seeing the speed of change that clearly is now accelerating, what conditions would you ascribe need to be fulfilled in India for us to also increase our acceleration to the same pace? In effect, we could leapfrog. There's no reason why we couldn't leapfrog on sustainability the same way we've leapfrogged, for instance, in digital public infrastructure. What conditions do you think are required for success over here?
Sure, I think it's a terrific question, Prashant. So given that we are still very much in the early stages of this whole story in India, I think the ecosystem you need to ensure that we make rapid progress also is just beginning to come together. But the good news is once most of the parts are in place, then it is something that can evolve very quickly. As Cyril said on the judiciary, for instance, you're just one judgment away perhaps from stoking some of these fires. So if I had to think about it, I'd probably put my finger on maybe three sort of sets of important issues. The first, I think, is related to policy. What you do need in this country is, I think, long-term policy and consistency of policy. And once businesses have a sense of what's coming down the pipe, I think they then start taking the actions to be responsive. So when I talk about long-term policy, you probably need, for instance, Anirban talked about decarbonization of the Mahindra Group. I think we need a decarbonization policy for India for the next 20 to 30 years today, so that businesses know what to anticipate 5 years down the line, 10 years down the line, 20 years down the line, and can start preparing for that. You need consistency of that policy. So what you can't have is something we've unfortunately seen too much of in India. For instance, governments, even at the provincial or state levels, changing the rules of the game, changing tariffs, for instance, on renewable energy, things of that nature. That's simply not on. You can't plan for a long-term future if you're going to have periodic short-term shifts in policy. On the sort of dimensions of how policy can be successful, the carrot and the stick, I think we talked about some of the carrots that are now coming in, the PLI schemes, things of that nature. And I think we need more of those kinds of incentives to push the sustainability agenda. So green procurement, for instance, in government policy, perhaps more of sustainable lending that forms part of the Reserve Bank of India's priority sector lending definitions and things of that nature. But you also need the stick. You need to enforce compliance more strongly. You need to create a compliance costs. The BRSR, as Cyril mentioned, could turn out to be initially just a tick the box exercise. There aren't necessarily major consequences for greenwashing or poor or inauthentic reportage just now, but I'm sure they'll come. But you will need that to force the pace of change. So I think there are a bunch of issues around the policy dimensions that are going to be very important. Then there are the enablers. And I think the biggest enabler perhaps is going to be finance. Last year before Glasgow, there were studies that suggested that India's requirement to even comply with its earlier Paris Climate Treaty related targets were going to be of the order of $170 to $180 billion a year for the rest of this decade. And currently the flows that are taking place are $17 to $18 billion. So just around 10% of what we need. So I think on the finance and financing of change in India, there's got to be a step change in solutions that are available and market intermediaries who can channelize capital towards the right kinds of causes. And I think the financial system is going to have to see much greater flexibility and innovation to provide some of the requirements. And finally, I think skills development, this whole ecosystem is going to need specialized skills across a range of areas and across the kinds of services that are required, from assessment of climate change, trained personnel who can offer commentary on sustainability products. I think there's going to be a need for much more talent that is available to really push the envelope on what corporate India and Indian businesses can do. In the past, sustainability, unfortunately, tended in many organizations to be a sort of fringe function, if at all it existed in those companies, sometimes getting coupled with spaces like CSR, for instance, or even administration in some companies. I think that's got to change now. And as we noted a little while back, the best companies are now beginning to see it getting integrated with the strategy function on even at the level of the chairman's office. But we'll need much more talent coming into the space to ensure that the landscape really does change speedily.
Mukund, really interesting thoughts. And as you walk through policy and what's required from a carrot and stick perspective, but also a number of the key enablers. I think one of the data points that stuck is this India, $170, $180 billion. And if only 10% of the flows are going in today, imagine the value creation opportunity as more and more funding comes in that will be driven by financial investors, but I think increasingly driven by aware customers, regulators that are perhaps a little more activist, but also employees where the best talent wants to work for purpose-led, mission-focused companies. And so I want to turn the nature of our conversation a little bit to the value creation side. With many forces coming in, disruption coming in, this is going to create significant opportunity. Anirban, maybe first for you, sustainability, many would say, is the next digital. What commercial opportunities do you envisage for Mahindra, both in India, for your businesses here and around the world, especially at the intersection of sustainability and digital?
Great question, Prashant. But before I try answering that question, let me reinforce something that Cyril said a little while earlier, which is the risk of existence to business is probably the biggest risk. And I'm choosing to reinforce this now because as you talk about commercial opportunities, this is the risk that comes into play. Because as newer technologies evolve, existing businesses need to embrace newer technologies to remain competitive. Imagine an automobile company not having an electric portfolio 10 years from now. Imagine a steel company not having green steel, say 20 years from now, 10 maybe a little bit too short. Imagine similarly a cement company, chemicals company, aviation, shipping, not embracing clean technologies. What sort of a situation would they be in the future? When I look at digital, to my mind, digital opens transformation opportunities in products and services. There are a lot of solutions which are there in the overlapping area between planet and profit. We've already seen the product portfolio of electrical appliance companies to have completely morphed. I don't think we've been noticing how that portfolio of products has changed. LED lights is famous, but the same things happen to fans and air conditioners and anything else that you name. In fact, the new fans that are, I think the first advertisement came out yesterday in the newspaper for BLDC fans. They save 60 to 65% power. And very soon, none of us will have the conventional fans in our house at all. And in every one of them, digital technology is playing a very big part. Software is a part of the solution. So much so that today you can talk to your lights and talk to your fans and talk to your air conditioners and get them to get going. My father's car had no software code in it. By 2010, the cars had about 10 million lines of code, helping improve fuel combustion in the main. Today, this has reached 125 million lines of code and is expected to reach 500 million lines of code in fully autonomous vehicles. Compare this with 15 million lines in an Android phone. You are getting as much code in an Android phone free along with your car. This is the way digital technology will transform products and services going forward. Conventional software solutions are already catalyzing lower emissions in every industry by simply taking enterprise solutions to the cloud. And this is one task that all IT companies, including Tech Mahindra, are doing at scale. These are many ways in which technology, digital technology, software code will catalyze solutions and make them far more effective. In a building, if all the hardware can improve energy efficiency by 30 to 40%. But if you were to add IoT and various kinds of software which does further optimization, that increase goes from 30 to 40 to almost 50 to 60%. So that's why we believe that digital technology can be transformative and can act as a force multiplier.
Thanks, Anirban. Thanks a ton for walking through a number of those elements. I had no idea about the number of lines of code in cars. So clearly a lot of change happening very, very quickly.
I will credit that to you, Prashant. It is your question that triggered that little bit of research.
Thank you. Mukund, turning over to you, we talked about limited regulation on ESG in India historically, and this notion of companies focusing, as Anirban highlighted, on risk mitigation for the first part, or compliance and risk mitigation for the first two parts. Many new ESG specific funds are being launched in India around the world, really with this focus on disruptive new business models, which will create new sources of value, both in public markets and private markets. And I'm sure as a private equity investor yourself, you're looking on, you're constantly on the lookout for new opportunities that might emerge. Which sectors do you think are best placed to see the most disruption, the greatest value creation in India?
Again, I think from a disruption perspective, I would tend to suggest that, on issues of S and G from an ESG perspective, honestly, there's not too much to choose across corporate India. I think many Indian companies have a long way to go in improving their performance on both S and G. And I think particularly on S, an issue like gender diversity at the workforce across the corporate sector, large and small, I think there's just so much that needs to be done. India's female labor force participation at around 20%, according to World Bank statistics, is much less than the global average of 48. So it's much more that needs to be done there. But on the E dimension, I think there are very interesting possibilities that are playing out. Firstly, on the disruption side, I think there are so many sectors that are going to be standing at risk of striding stranded assets in a few years' time that no investor wants to back. Think about the oil and gas sector, think about thermal power, think about automobiles in the ICE internal combustion engine space. As the shift to electric vehicles happens, I think there'll be many of these companies and their component suppliers who are going to be left with businesses that could potentially be struggling if they've not made the decision to pivot or to expand their business framework to do other things to continue to ensure that they're able to earn income and keep the revenue going. I think there are a number of other spaces that again get impacted by climate. Think about metals, the hard to abate sectors like steel, think about construction materials, including cement. I think all of these will see a lot of innovation take place, but also challenges from new age companies that are trying to substitute what some of these companies can offer or do. There will be sectors that support a lot of the transition that is already taking place. I think telecoms and IT, for instance, are going to be great beneficiaries of the fact that, in a sense, geography is now history. The fact that we're doing these kinds of video conferences using these kinds of technologies and reducing our own personal carbon footprint, no longer traveling for meetings, all of that makes a big difference. But I think the most exciting part of what we see in the market now is a lot of the new startup activity around new opportunities that are opening up. So on the one side, we had disruption, and there are penalties and costs for companies that don't pivot away from problem areas. But equally, there are a huge number of new opportunities that are opening up. We talked about one of the big enablers for a better ecosystem in India being skills, for instance, and services. I think you're going to see a number of new services, data analytics that are going to come up that are going to be very important for companies to be able to measure and track their ESG performance. You're seeing companies that offer satellite-based services looking at remote sensing data and offering you a sense of what your environmental footprint really is as a company. New materials that are coming up, alternatives to meat, plant-based alternatives. So I think a whole bunch of new industries that are beginning to be seeded. And I think Startup India, in that sense, is doing some great work in establishing new propositions that I think investors are going to be very, very excited about across agriculture, across natural resources. And as I said, in some cases, offering new competition to traditional industries, including all that you're seeing in the electric vehicle ecosystem, challenging conventional transportation. So lots of excitement, but also I think the need to worry if you are an established company with potential risks of stranded assets for the future.
And Mukund, if I had to put you on the spot and ask you to make a bold prediction about how many years before we see our first climate tech or sustainability-based unicorn in India, how long would you say? Is it 5 years away? Is it the end of the decade? One number, just to put you on the spot.
I'd say in the next 3 years, you will probably see a unicorn which has a strong climate proposition to offer the market.
Wow. So it's really round the corner in some instances.
Absolutely.
For startups.
And you might see it in a space like carbon credits trading, new sustainability products exchanges. I mean, there's a world of opportunity out there. Anything that has a sustainability quotient and can make a difference in people's lives is going to start attracting capital very soon.
Wow. Cyril, want to turn to you. As we've discussed, the potential of value creation across multiple sectors is very high. These shifts are creating winners and losers as we speak. Sectors like energy that have moved so quickly to renewables from fossil fuel-based power on the basis of regulation, investor and analyst expectations. What opportunities from your perspective do you see for business houses that capitalize on ESG quickly? And maybe is there any regulation that you would say the government should draft to accelerate this transition and help India emerge as a leader?
So a lot has been said by both Anirban and Mukund in terms of the opportunity. I think the startup space is going to be a very big sort of segment of the market where a lot of innovation will take place. But I see a lot of investment coming in, and therefore, in terms of the opportunities for attracting private equity, attracting strategic investments, and then eventually taking some of these companies to the market, I think you're going to see a lot in the financial markets because of the underlying technological change. But if I can step back a second, I think finally this is a lot about science and technology as well. And part of the reason why we are kind of perceived to be a little slow is because there is not enough impetus on encouraging fundamental research and science and technology as well. But I think that the approach of the government in terms of some of the announcements that we saw in the budgets is to put an increasing focus on just pure hard R&D and scientific research. And if that picks up, I think you see a lot of tremendous opportunities coming up. So we don't have very well organized research between centers of excellence, universities, and others. And if somehow the policymakers could figure out a way of connecting all of that, you'll see India become a big research center for the world. Because it's ultimately a lot of our scientists who go out there and they do so well. So the brain power exists, but the institutional architecture, I think, is missing. And the ability to incentivize fundamental scientific research. So I think research is going to be a big opportunity. Just thinking aloud, like if you can have PLI for kind of Make in India, why can't you have a PLI like thing for research in India as well? And every single thing that we discussed today is going to the bottom of it is going to be the ability to drive science and technology and research to make this possible. At the end of the day, this is all science. And the finance will follow, and finance and the markets will follow after that. So I see, we're just probably at the initial cusp of developments on this. Science will go very fast, and markets will follow. Is the way I see it. You gave the example of renewables. We've seen, the kind of market capitalization that has been created so quickly in moving from fossil fuels to renewables. And the game has just started. The real stuff is going to happen when EVs come in, or when you have a lot of other ancillary industries, whether it's charging stations. I mean, I don't even know the science properly, but I can just imagine a whole arena of ancillary industries where the capital is going to chase it, because these are all virgin, and the opportunity for an upside is incredible. So I think it's opportunity.
Thanks, Cyril. And one of the data points that I found quite striking in an article by the New York Times recently is that $30 billion of VC money went into climate tech last year, especially in the US. In India last year, we know the total VC money across the ecosystem was about $35 billion. And you can imagine the opportunity if some of that money, many funds are already looking for those opportunities for disruptors, innovators, young students and engineers out there. There's a real opportunity to really build the next wave of sustainability-oriented unicorns, or to work in large companies to really drive some of that change. I wanted to, I'm being conscious of time, and so I did want to spend a few minutes quite specifically on India. And Mukund, perhaps I'll start with you. The sustainability field is quite nascent. And, not that and several of the Nifty 50, for instance, don't yet have a chief sustainability officer in place. And that I'm using more as a metaphor for the different kinds of talent that's required to achieve and what the journey that enables on at Mahindra, or to create the kind of change that we're talking that startups need to have. It's like the software industry or the IT services industry. You just needed a lot of different people with skills and talents that came together to create the change that we've seen. What advice would you give to Indian startups and companies that are looking to embark on this journey, particularly from a talent perspective?
Sure. So I'd probably suggest at least three things. The first is, even if you're a startup, don't delay embracing an ESG agenda, and don't delay the idea of creating a locus of governance in your organization that keeps shining a light on this issue. Now, it doesn't mean you have to create a role or a designated position called Chief Sustainability Officer. It could be the CEO's responsibility. It could be a small ginger group in the management. It could be somebody at the board level who has an interest in the subject. But make sure that there is a discussion that starts. And it's very important to build this in, I think, right at the start. And if you think about sustainability across all the dimensions of E, S, and G, issues like corporate governance, I don't think brook any delay in terms of when you introduce best practices. I think if you can embed it right at the start, make it part of the culture, then it's much, much better for the organization and its future sustenance, as opposed to trying to do some retrofits later or trying to change the culture once it's already been set. And I think you're already seeing in the market these days a lot of headlines around startups where there have been controversies generated, perhaps because some of these issues didn't get the attention they deserve when the organization was being set up in the first place. So that's the first point I'd make, that the tone at the top, the governance is very, very important. Don't delay assigning responsibility for these issues to somebody there. The second is, you don't have to churn the ocean. And this is where this concept of materiality is important. Look at the few things that really matter to your business and its future success from a sustainability perspective, and focus on those to start with. There are ESG ratings providers who look at over 700 parameters, but the organization, if it's a startup, doesn't have to look at 700. Start with 3 or 4 that you think are going to make a big difference to your business. And really work on a roadmap and a plan for the future. Even when these days, there's a lot of talk about net zero in the context of climate change. But think about the targets companies are setting on net zero. Typically, they are 15 years out in time, 20 years out in time. So it's not that stakeholders are expecting you to have a plan that delivers an impact tomorrow, but they're expecting you to at least think about the future and have a plan that at least 10 years, 15 years from now delivers the impact that they might expect. So I think it's important to at least have the beginnings of a roadmap. Don't get daunted by the sense that this is a lot of work and is going to take up a lot of cost. Think about it as the beginnings of a journey, and you need to start that today.
Mukund, thanks. And I think my takeaway is don't think about sustainability as being an adjunct to your strategy, but think about really being conjoined, weave it into your strategy to create disproportionate value. And I believe, as you've said, we've talked about technology driving higher multiples. I think sustainability plus technology could drive even higher multiples going forward. Anirban, to you, and relatively quickly, how can Indian companies work with the broader ecosystem in India to encourage and scale up solutions and on-the-ground initiatives? Are there interesting startups or not-for-profits, for instance, that you think companies could work with, which will drive significant impact over the next several years?
Prashant, a little earlier, you talked about leapfrogging in India. It seems to me that working with the broader ecosystem and startups is a way of leapfrogging. But then if you were to ask the question, what does leapfrogging really mean? Here's what comes to my mind. If we want to leapfrog, let's say, the West, then we will develop along a green path vis-a-vis decarbonize after development. That will give us a sustainable path of growth where our country will do well, the social issues will get taken care of, we will use the best possible technologies, and always have a low carbon footprint in the path of our growth. There are 4 possible ways in which I can think of working with the ecosystem. One, of course, is decarbonizing your suppliers and value chain. Second, building decarbonizing solutions and go to business with them so that more people can decarbonize themselves. Third, invest in new clean solutions through startups. And fourth, even if you can't invest in them, provide living labs where prototypes can be developed and solutions can be built and for subsequent scaling in the marketplace. Within the Mahindra Group, we've worked with 350 plus suppliers to help decarbonize them. Our two biggest programs so far have been the LED program and the motor replacement program. We see the renewable energy program to be the next big lever to decarbonize suppliers. We've built 7 new businesses at least, which can be called green businesses. I will not list them all out in the interest of time. We've invested in a few startups in the area of shared mobility. Again, a climate solution for the future. And we are very keen to provide opportunity and space for startups to use our facilities as living labs. We've had 1 or 2 examples already. We're quite happy to enable the creation of new climate solutions, which will help all businesses be sustainable going forward. So these are the 4 ways in which we can think of working with the ecosystem. I don't know whether it's comprehensive or not, but at least 4 good ways of working with them.
Wonderful. Thanks, Anirban. And Cyril, I'll come to you for the last word. what opportunities, whether it's regulation or otherwise, do you think, the government or the broader Indian corporate ecosystem need to take to really help us drive leadership on the environment front? What needs to happen?
So, sort of number of things, and I'm also conscious of the fact, and I think so is the policy establishment, that we are taking the presidency of the G20 next year. So I think there is an amazing opportunity for India to lead this conversation in a much broader sort of global context, rather than only in a national context, and we could help prescribe really the standards or evolve the standards for a lot of these things. So that is one opportunity which I think we should not miss, and I'm sure that there is a group working somewhere in the ministry which is looking at this. The second, I think, is one of really capacity building and capacity creation. I think Mukund touched upon this briefly, but I know for a fact that the talent is very short in this. I think there is a need in various universities to build a large pool of ESG fluent engineers, lawyers, policymakers, whatever it is. So that's the second opportunity, both from an education point of view as well as in terms of creating impact. And here is where I think India is important, because of the size of not only of our population but such a large proportion of STEM talent. This is relatively easy to do. And I think the third opportunity really is kind of newer ideas. For example, carbon trading. Today there is no framework for it. So there is just stuff that is ready to be invented in India. Whether it's green finance, social stock exchange, which is kind of beginning now, but we need to get it right, because all the other countries who have tried it have failed. But we are number 15, but we can still get it right. So there is this horizon of doing some new things and also doing some of the old things better.
Cyril, thank you. With that, I would suggest we pause here. We could go on for at least another couple of hours. The time we've had has just flown by. Thank you very much, Cyril, Mukund, and Nirban, for sharing your deep insights and your thoughts on this extremely exciting topic. One takeaway of many for me over the last hour has been that our next sustainability-linked unicorn is just 3 to 5 years away. So for those young disruptors, innovators, and scientists that are looking at creating disproportionate value, this is the place to be, ESG. Thank you. Thank you so much for tuning in to ET India Inc Boardroom. Stay tuned for more.
All right, good afternoon, everyone. My name is Deepak Jain. I'm a partner at Bain & Company. I run our industrials business in Asia Pacific, and I do a lot of work in auto and EV sector. I will be the moderator for today in running this session on electric vehicles and its contribution towards sustainability. To start with, I want to thank ET for organizing this session and giving us this opportunity to have the discussion. We have a lead set of panelists today to discuss the topic on electric vehicles, whether it's truly a reality or not. And I will just take the next few minutes to first introduce our three panelists. We have Mr. Ketan Mehta. Ketan is CEO and co-founder at Hop Electric, and he will talk a lot about the two-wheeler OEMs and its role in the electric value chain. Next, we have Mr. Punit Goyal. Punit is the co-founder of BlueSmart. BlueSmart is an Indian ride-hailing services company and headquartered in Gurgaon. And Punit will bring some perspectives from the e-mobility space. And finally, we have Mr. Ravneet Pukela, who is the Chief Business Officer for ET Energy. And he will again talk about the two-wheeler and two-wheeler EVs and the role of that in the electric value chain. Welcome, gentlemen. Thank you for taking time out to be part of this session. Before we start, I just want to share a few points from my side on the electric vehicles, because this is a space which is quite exciting, as we all know, and we as Bain have also done a lot of research on this area. So I will just throw 3-4 points on the table, and hopefully that will give us a good starting point for a discussion. As many of you know, EV is growing very fast globally as well as in India. The penetration level of EVs in the global industry is expected to reach 75% by 2040, which essentially means 3 out of 4 vehicles which will be sold in future by 2040 will be electric vehicles. This trend is, of course, led by Europe and China, but is now percolating down to other geographies very, very quickly. Number 2, if you talk about India specifically, the EV penetration, particularly in the two-wheeler, three-wheeler space, has been very high already and is growing very, very fast. Will definitely touch 25% plus, for instance, in two-wheeler space within the next few years, while four-wheelers are also now catching up and should hopefully reach 10% plus within the next 3 to 4 years. The single biggest driver of EV penetration has been the total cost of ownership, TCO parity, as we call it, which is expected to be reached for most segments by 2025, except for commercial vehicles, which may take another 5-7 years to get there. And finally, EV is also an important topic because it's one of the areas which can help us achieve our carbon neutrality goal. I don't know whether you know, I was conducting another conference 2 days back, and I got to know that transportation contributes 14% of all the CO2 emissions in the country. So if we are able to penetrate EV in a big way in the country and replace some of the ICEs, that will also help us in meeting our ESG and carbon neutrality goals. So that's just a little bit of backdrop. With that, let me come to the agenda for today's session. We'll in the next 40 minutes or so, we'll try to cover 3 broad areas. Number 1, we will have a few questions related to the evolving EV landscape, where I will invite our panelists one by one to talk about them. Secondly, as I said, EV will play a critical role to meet our carbon neutrality and ESG goals. So we'd love to get some perspectives there from each one of you. And finally, we'll talk about the key enablers and challenges related to EV penetration in India. That's one area where I have 3-4 questions related to the charging infrastructure, technologies, government support, and so on. So we'll just go deeper into that aspect. So that's what we will do over the next 40 minutes or so. So with that, let me get started and move to the first area. And I will request Ketan for you to come in first. My first question is on the EV landscape. What do you think is the landscape looking like for EVs in India? And do you think we have reached or we are reaching an inflection point which will accelerate the growth of EVs going forward? Ketan, over to you.
Thank you for the introduction, and thank you for inviting to this panel discussion. So, in my opinion, I think EV is, of course, it's a combination of a lot of factors, but the landscape, the opportunity looks very, very bright right now. It is, of course, the impetus is given by the government policies right now, whether it's FAME or whether it's the GST and all other factors, income tax benefits and all of that, which the government is giving. But apart from that, fundamentally, there is a very clear mandate globally that clean energy, ESG, all of this is a very big theme, and especially after COVID. So I think the mindset is very clear that yes, we have to move towards cleaner and greener avenues, and electric mobility ticks all the boxes. And government is also trying to promote, especially if I talk about a country like India, which imports almost 80 to 90% of its fuel. It's a win-win situation from both sides. One is you are cleaning the environment, and second, you are reducing the burden, of course, provided Make in India picks up with all the the manufacturing and all. You are replacing your import bill also. So it's a win-win situation from the consumer side. If I talk about, of course, there are subsidies, there are tax benefits and all of that. Plus you get access to a superior kind of performance technology. And now, we are seeing, EV being much more superior in terms of even user experience as compared to the traditional ICE vehicle. So it's a combination of all these factors. I think the landscape, if I talk about the current scenario, I think it's like an exponential growth which we see over the next few years. The inflection point, I think the announcement of FAME policy was one big sort of game changer for the industry. Where things have suddenly become so bright, and the growth rate has accelerated so much that, yes, I would say that inflection point has reached. But yes, it's driven by subsidies currently. It might not last for long, but yes, it's given a good kickstart to the industry to sort of stand on its own feet and take the next steps and take it forward. I mean, not only FAME, I would say, let's say PLI scheme which has been launched, and the other source of benefits, and the swapping policy which is now coming out in the budget. All of these things, I think, in the right direction, and that inflection point, I would say, yes, it has come over last few months.
Thank you, Ketan. You talked about a bunch of drivers which are leading to the growth in EVs, and we'll come back to them in a few minutes and talk about each one of them in more detail. But before we do that, I have one question for you, Ravneet. Ketan clearly thinks that we have reached that inflection point, but is that true for every segment of EVs or automobiles in India, or you see different segments behaving differently?
I think most definitely there is it differs by sector and vehicle class. The obvious one, the lowest hanging fruit is two-wheelers, and within two-wheelers is scooters. So in the month of January, the e-scooters were about 7.7% of all scooters sold. The month prior to that was 6 point something percent. Prior to that was 5. So almost month on month, we're seeing a 1% increase, right? So looks clearly from a scooter perspective, I think that train left a long time back, and right now I think with the momentum that we're seeing, it is irreversible now. So it's really a question of more products coming in, credible products coming in, and very importantly, solving for the supply situation that is killing all of us at this point in time. So scooters is on its own path, right? I'd say that things like e-rickshaws, three-wheelers, etc., are again, I think, on a good path, because the use case there is really centered around TCO, where it's not as much as about great performance, great build quality. As long as it's reliable, it runs, and it's it has good TCO. So that proposition is technologically not very difficult to put together, to build a product like that, right? So those are obvious cases, right? Buses, etc. While the TCO will take time, but parts of that entire set where government has direct control, state or central, it sort of is being driven by almost mandates. So anything that's driven by mandates takes its own time, but at least there's a push that's in the right direction. I think from what I understand, the slowest are going to be cars at this point in time. Firstly, there's a question of just choice and availability. Like, there are no options, honestly. So even if today you have like 25 lakhs in your pocket, 20 lakhs in your pocket, like you have like 2-3 choices, unlike petrol, for the same money, you have like 25 choices. So and even if you look at the announcements made by people, forget what's already out there, just the announcements of when people are introducing, I'm talking about scale players. We're still a few years away before we start seeing proliferation of, of vehicles across different need state, different demographic segments, different price bands, etc. So that'll take some time. Also, the TCO, takes, for those who are driven by TCO, that'll take longer, because while the percentage difference may be similar between a scooter and a car, but the absolute is very high, right? So it's really, the driver is different than it is for a lot of two-wheelers. But I just want to make one point about this whole TCO business. While it's important, but one point that Ketan made was that the reason we see a lot of change of late, of course, there's FAME and therefore pricing is better, the sticker shock is lower, etc. But people are recognizing electric as a superior product, as an upgrade, as opposed to this saves the world or this saves me money. Because if that was to work, we've been selling scooters for the last 12 years in this country, like more than that, 13 years, 2008, 2009, when we started selling. If that logic was enough to make people buy product, we should be selling in billions by now. But the fact is, we did not, right? So it's only when people see this as a credible alternative to petrol scooters, and in this case, actually, is an upgrade in terms of the basic drivers of what a scooter is meant to do. The drive, feel, dynamics, top speed, acceleration, handling, banking, whole bunch of things, right? Once you cross that bridge, people say, you know what, I could have bought a Honda Activa or something else, but this is good enough as a scooter. Then you start, this conversation about, hey, this is touchscreen dashboard, remote diagnostics, and those are multiple layers, right? So I think if you look at all that put together, scooters are really on their way. Honestly, right now, every credible OEM today is able to sell whatever they can produce, and everybody has a line outside their door, not being able to supply what we have to. So I think so. We've reached an inflection point, most definitely, as an industry.
Very interesting. So I think what you're saying, Ravneet, is two-wheelers are of course ahead, three-wheelers are not far behind. Buses, not because of economics, but because of government mandates, will hopefully get there. And then there's PV, where there's lack of choice today, but hopefully will come as more and more companies are coming out and announcing new models. Hopefully over the next 5 years, that will accelerate. Very useful. The other interesting point you made is about people looking at EVs more as a genuine alternative or credible alternative to upgrade, rather than just thinking about let's say cleaning the environment, right? Because the economics and that upgrade really plays a vital role, which is where I think Ketan was also going from a mindset change perspective. We'll come back to it. One area I do want to probe a little bit more, and Puneet, I will invite you to answer that question, is even though Ravneet just said that the more important factor is about upgrade rather than thinking about cleaning environment, but to what extent EVs will help us in meeting our ESG or carbon neutrality goals? There are other things happening, right, in the country. There's solar growing very fast, there's wind coming in, a bunch of other initiatives government has launched. So where do you place EVs vis-a-vis other areas or initiatives that government is pushing?
I think Ravneet and my colleague, they have made the clear point that EVs will take time to grow. Ketan and Ravneet, it will take a lot of time for EVs, EV adoption to happen, because the big challenge that we see is charging infrastructure has not been developed. And like Ravneet pointed out, that a lot of manufacturers have not started manufacturing EVs, but that is changing. That's changing globally, and that's changing in India also now. Our thought process was a little different. We knew that this is going to take time. We were watching the telephony revolution. Some people got their first mobile phone in 90s. Some people got in early 2000s. Some people are still buying their first mobile phone in India now. And it took India nearly 28 years or 30 years to completely shift from landline phones to now everybody having a cell phone. So we really believe that this is a long-term game. The next 20 years, India and China will be the biggest adopters of electric mobility. And because, like Ketan also mentioned, India imports a lot of fuel. So we believe at Blue Smart that it makes sense today. And why we are doing it? Because of the TCO gain. So if we see the running cost of a taxi, unlike a car which is driven by individuals for 60 kilometers or 80 kilometers use case, you're not able to utilize the car for that matter. And a lot of people are shifting now towards not owning cars and probably subscribing a car. Taxis run for more than 200 kilometers. So we really believe that all globally, and if I'm sure you're doing so much of research globally, that all ride-hailing fleets in the Western world, in India, will eventually go electric. And that's largely driven by TCO. The cost of operating the car is super low. Today, we're talking of 2 cents per kilometer versus CNG or diesel or petrol, which has seen exponential increase in prices. So the cost of CNG has gone up by 50% in the last 4 or 5 years. The cost of petrol and diesel have gone up by 100%. So 2x increase in the cost of petrol and diesel from the 2016 circa to the 2022 period right now. The cost of petrol and diesel has gone up. So we firmly believe that all ride-hailing fleets will eventually go electric. Consumers will eventually buy electric cars in mega cities where obviously cost of operating the car is only going to go up. So it's eventually going to go mainstream, but for taxi, it makes sense today. And now, in case of transportation, it contributes nearly about 20% plus to the air pollution megacities of India. So it's very, very important. The AQI is north of 250 all through the year. It crosses 400 in the winter season. So I think it's imperative for public transportation fleets, buses and taxis to first accelerate the adoption of electric mobility in mass scale on the back of better unit economics, on the back of falling cost curve of cars and batteries, and eventually individuals will also shift to electric cars. So yeah, this is my thought process that we have to shift to electric because of the pollution challenges, and also it makes unit economic sense.
Very helpful. Ravneet or Ketan, you want to comment on anything related to the ESG related contribution from EVs based on what Puneet just said?
So I think it's an easy win to my, the way I see this is that if you're able to transition the mindset from ICE to EV, then you're just setting us up in a direction which doesn't need selling every time. Like once you buy into the electric dream, then your second, third, fourth vehicle, etc., this is always going to be electric. And so the idea is to, if we can make this cross the hump now, which like I said earlier, in some categories we already have, then the impact is very, very profound, right? So the impact is not just limited to ESG. We talk about geopolitics and oil, and well, there's a war right now. I mean, eventually the ramifications of this are really, really huge. The industry many times get dissed, by a lot of people saying, hey, listen, the generation is still from coal, et cetera, et cetera. Sure, that's true, but that's a parallel path you're following with or without the EV revolution, right? So that's anyways happening, right? So I think any which way you see it, but the only call out I have here, Deepak, here is that while transition to EVs is great for the environment and meeting our goals, what's great in reality may not be the selling story for consumers.
Yeah.
So if I start telling you, hey, buy electric because it will save the world, quite honestly, being in the business, I can tell you nobody wants to pay a penny to save the world, right? So saving the world is the government problem or somebody else's problem. Mujhe gaadi chahiye, right? So essentially, you give a vehicle that consumers love, and that happens to be EV, and that's when transition happens in mass scale.
Wonderful. Let me move on. I will come to the next section where I want to talk about the key drivers for EV penetration, and in your opening answer, Ketan, you touched upon some of them. The way I think about it is I divide it into 4 parts: charging infrastructure, technology, economics, and government support. And there could be more, like you talked about the mindset, consumer perception, etc., etc. Let me just first focus on these 4 and start with charging infrastructure. There's a lot of news on charging infrastructure. Everyone wants to do it, and I think the companies 3 of you belong to have also been doing a lot in this space. Where do you think we are today? Let me ask Ketan first. Where do you think we are in terms of charging infrastructure? How is it evolving? And are the initiatives that are being taken by both government and private institutions enough to support the kind of growth we need in EV over the next few years?
So see, charging infra is it's like a chicken and egg situation. Vehicles and charging infra have to go hand in hand. One cannot happen without the other, or one cannot happen before the other. It's just not possible. So I think it's both are working in parallel, and it's a lot of work to be done. And because something is being built from scratch, there was nothing there, and it's being built. So, but yes, I think the initiatives taken by the government definitely are there. I've seen a lot of PSUs and a lot of oil companies and a lot of these energy companies coming in and putting up sort of charging infra and all. Also, the need for so we are a big believer in swapping infrastructure, honestly, for the 2 and 3 wheeler category, and that's where we want to make. I mean, of course, people can differ on this panel, but that's where we believe the game lies post the FAME subsidy and post the government incentive gets over. That's where the real game lies for this category of vehicles, 2 and 3 wheelers. So that's where we are building our technology and our infrastructure. The swapping policy is going to come out probably next 2 or 3 months. We had a good session with Mr. Amitabh Kant a couple of weeks back. So yeah, so that's where we believe it's going to, we'll sort of invest and we'll sort of set up the infrastructure. And that's where we believe it's our game sort of differentiation factor on the energy infra side. At the same time, I think the four-wheelers and the other sort of form factors, I mean, probably hydrogen will kick in at some point, and so a different kind of infrastructure is needed for that. And for probably cars, a different kind of infrastructure is being set up. So I think it's a work in progress. It's a very necessary thing. We cannot deny that. I think, as per my sort of information from the market, 80 to 90% of the consumers who buy or not buying EV today is because of range anxiety, or it's because of the charging infrastructure related issues. So that's the biggest bottleneck why people might not switch to EVs. And so we have to solve that together. And if that is solved, I think the transition will be much easier, much faster, and it is definitely, it is going to take place. And this is an enabler for the consumer to believe in electric vehicles and to believe that they will not have any issues and any problems with that. So I think this is the biggest sort of driver, and we cannot ignore that. So yes, this is something to focus on, and I think the right policies and right initiatives are being taken. Of course, it's a work in progress.
And Ketan, if I may just probe that a little bit more, because I know you guys at Hop also are doing something on, I think, battery swapping and other areas. So you want to give a couple of examples on the kind of innovations which are happening on charging infrastructure, if you have something in mind.
So I think what we are doing is, so we've been running our pilots across cities for last almost now 14 months. We've been experimenting with various business models, various batteries, various consumer sort of expectations. How to just fit in, because of course right now you have FAME where you have 40% sort of subsidy being available, but that's not going to last forever. And battery prices are honestly not going down as was believed. Probably in the long term it might, but I think what I've seen over the last 6 to 12 months, it's only going up or stable, whatever. And the material shortage and all of that is going to kick in because the demand is increasing. So on the technology front, I think what we've experienced is one is the so our technology we have developed is compatible with both 2, 3-wheelers, L3, L5 scooters, all of that. So the infrastructure has a quicker payback time, so that because it can be used across form factors and across vehicles. So that's in standardization we have done. Second is on the battery life, because the swapping infrastructure works well or works best when you can enhance your cycles and battery life. And probably it's not as much of a concern for a fixed battery system, but it is much, because every cycle gives me an additional return on my investment. So we have worked on that a lot, and with various sort of not only chemistries, form factors, various through software we are able to enhance our battery capacity by at least 50, battery cycle life by at least 50%, just by software changes. And that is what we have learned over the last 12 to 14 months. And that's what, once the swapping policy comes out, we are going to implement that at a larger scale. Keep learning things about the habits of people, how they charge, how they swap, at what times, and so it's about sweating your infrastructure as much as possible. So as many swaps I can do from my swapping station. So a time of day kind of concept where the morning rush hours and evening rush hours probably have a lower cost, and afternoon you have a higher cost. You have a higher cost, and afternoon you have a lower cost. So those kind of innovative business models is what we are experimenting with right now. We are providing sort of an unlimited battery warranty in a way with our vehicles, with a swapping sort of package, because we are able to upgrade our batteries as and when required. And recycling of batteries will become a very, very big play, because all of these batteries have a limited life, probably 5 years or whatever. So, and so many vehicles coming on road, and then so recycling and getting the material out is another big aspect where we are working on, and that's something will make this entire ecosystem sustainable. Otherwise, the mining and getting new materials out is actually very, very toxic for the environment. So as much as we can talk about the the environmental sort of savviness, but the real place where the work happens. I mean, it's not that it's quite toxic. So I think the sustainability is very important. If you can recycle the materials and reuse that, that will be very, very important. And that's where we are working on that technology. So I think these are some of the factors. And then thermal management of batteries. We have active thermal management in our batteries where we are able to control the temperature, in the summer especially, because we started in Rajasthan and Jaipur where temperatures can go as high as 48 degrees. So it was very important for us to do that, and that's what we worked on and developed that technology. So I think there are various sort of aspects where things have been developed, and once the sort of policies are there, I think it will be time for us to sort of implement those. Yeah.
Wonderful. Thank you, Ketan. Very comprehensive. Let me just in the interest of time move to the next area I want to touch upon, which in my mind is a big enabler of EV's growth. I would say the way I frame it is new technologies and new business models. And Puneet, let me invite you to throw some light on these two areas. And the specific question is, from a technology and innovation perspective, what kind of new areas which are emerging in the whole EV value chain? And second is, more specifically, what kind of business models we can see in near future? In fact, your company itself, BlueSmart, is kind of a new business model which has emerged over the last decade or so. So do you see some more new business models coming up? So maybe break it into two parts. First, talk about technology and innovation, and then about the business models.
Sure, Deepak. So, so we knew from day one, the first, so now we have 3 generations of cars in BlueSmart. And we knew when we were writing the white paper back in 2016, 17, 18, these were still early days for us. And we didn't have any electric cars in the market, which probably had range anywhere near 200 kilometers. And we figured out that this is not the right time. So timing is very, very important, is something that we understood at an early stage. In 2019, when we started with first 70 cars, the initial cars came with a small range, low range of about 110 kilometers. With each passing year, the range increased. Today, the cars that we are onboarding, now we have about 1,020 cars on road on the BlueSmart platform, which is the largest fully electric ride-hailing fleet in Southeast Asia. And the new set of cars which are coming are about 220 kilometers in terms of range. And as we speak to more and more manufacturers in India and globally, we understand that 2022, 2023, most of the cars which are going to come will have range of 300 kilometers. We have some cars, about 40, 50 of them, which have range of about 350 kilometers, which are little high-end cars. But majority, 90% of our cars are in the range of about 180 to 220 kilometers. In terms of industry, we also wanted to see the use case of these cars. We do not currently operate in the entirety of Delhi NCR. For operating in the entirety of Delhi NCR, we need about 25,000, 30,000 cars. By end of this year, we should probably scale to about 4,000 cars. In terms of business models, we thought that ride hailing is the best place to start with a very differentiated supply side model and a very consumer centric business model. There are 2 more incumbents in India which are in the ride hailing space for the last 10 years. But we saw for the last 2 or 3 years that the supply side on those 2 platforms were coming down, like crashing. And, 0 cars were added on those 2 platforms in the last 3 or 4 years. So we thought that why don't we build a different type of supply side model wherein drivers will not need to own cars. So in our model, drivers do not own any of the cars. We sign institutional lease agreements with massive institutions who lease electric cars to BlueSmart. This is again an innovation. We have been able to, at an early stage, sign agreements worth 15,000 cars, where BlueSmart will onboard 15,000 electric cars on the platform BlueSmart through 6-7 large global institutions who are investing in electric assets. Now, my colleague Ketan and myself, we both come from the renewable space, and we knew that these are depreciating assets, whether they're solar panels or wind or electric cars. And there are few global institutions who believe in investments in these assets. While the assets depreciate, with a capital D, you also make money. So that was one innovation. And I think that we are seeing similar companies like BlueSmart with similar fundamental tenets in the West. So you have Via, you have Ride Alto, and you have Revel. Revel recently raised $126 million from BlackRock 2 days back. And with similar fundamental tenets, the assets are not owned by individual drivers and assets are owned by global institutions. On the customer side, we again wanted to offer a customer-centric ride-hailing service. So we launched 2 industry-first features of zero ride denials and zero surge pricing. Of the 33 million kilometers we have covered, serving close to about 12 million trips since launch. And these have been without any ride denials. These have been without any surge pricing from our side. So that was again an innovation in the ride-hailing space. No company in Asia offers zero ride denials and zero surge pricing. These are industry-first features in ride-hailing space. There are several other car sharing, scooter sharing platforms in India. I think they are also eventually going to go electric. We believe that most of two-wheelers, in fact, obviously, India has the lowest asset ownership. Less than 3% of Indians own a car. India largely is predominantly a two-wheeler market, which Ravneet and also Ketan highlighted. We believe that most of India will really see a great adoption of two-wheelers, for delivery purposes or logistics purposes. Also, individuals will switch to electric because of the lower cost of operations. So there could be some business models being built around there where you could do delivery on two-wheelers, or you could probably use a two-wheeler for logistics. But predominantly, we believe that we see a huge opportunity in building a fully electric ride-hailing fleet, which is a full stack model. So like Ketan was saying some time back, you need to have control over charging infra. So what we also did is that not focus on building a ride-hailing business, to build a full stack ride-hailing model. So we also operate India's largest network of EV super hubs. This is again an innovation from our side, although it's happening in the West. The largest EV super hub in the world, one of the largest, is being operated by BlueSmart today. The largest EV super hub in the US is operated by Revel. They converted the old Pfizer building and deployed 25 fast charging stations at one single location. We have built 9 such EV super hubs in Delhi NCR. Each EV super hub can park and charge 80 cars simultaneously. Seamless charging infrastructure. You zoom in with your car, charge your car, and zoom out, which also means the utilization was very high. BlueSmart could utilize these chargers. Our utilization rates are 33%, which is the highest in the world in terms of charger utilization. We got a lot of data from energy companies and standalone charging infra companies, which showed up data of about 14-15% in terms of charger utilization. All the chargers that have been set up by us, we have 350 fast chargers and about 600 slow chargers, nearly about 1,000 chargers on our platform. And these are with a utilization of 33%. So that again, we see as a huge opportunity in the charging infra side. And if you can probably bring it together, connect real estate, energy, infrastructure, and mobility. And if you can connect all the 4 dots, I think that is what India needs. That is the big challenge that we all have to solve together. Put all the pieces of the puzzle together and build out a fully electric ride-hailing service and a charging for service. Basically, create an ecosystem. So there are good opportunities for other companies to also address this EV ecosystem challenge. And if you can address that, I think then that's a very solid, fundamentally very solid business model, which has a massive opportunity to build upon. These are my thoughts.
Very, very helpful. Thank you. Thank you, Puneet. Ravneet, let me bring you in here. This point that Puneet made, that ultimately it has to evolve, no matter where in the value chain you're starting from, it has to evolve into a full stack model with leading players controlling different parts of the value chain, what he also called the EV ecosystem, building it. What are your thoughts on it? Do you agree with him, or do you have a different point of view? And secondly, in that context, how do you think about, let's say, your portfolio in future? Is it going to be going deeper into the OEM play, which you're already doing, or spreading more across the value chain and doing other things and capturing the profit pool in other segments?
So I think agree with Puneet. I think we're also very strong believers in an ecosystem play. This technology and this industry where we are at this point in time just allows us to relook at how the mobility game is played for a variety of reasons, right? So there's a ride-hailing view that Puneet has sort of laid out. Let me lay out an OEM view on the ecosystem. So if you look at if you look at the energy spectrum, so there is generation of energy, there is distribution of energy, there is storage of energy, and there is application. Let's say there are 4 stages there. Right? Generation is a place which is, I think, a place too far from any OEM, right? But if you look at that today, as what looks like a scooter company today, talking about Ather now, we are in the distribution space through a charging infrastructure business. We are in the storage space. Today, our storage is limited to automotive batteries, but as anybody who's been in any space will tell you, the most demanding use case, or one of the most demanding use cases for batteries is automotive. If you can crack that, everything else is sort of becomes quite easy, right? From a static storage perspective and a bunch of other use cases, right? And then there is application, which today in our case is scooters. So we're already playing in a larger energy space. And if I fast forward, let's say 2 years, 3 years, the charging infra we likely to have maybe in about 2 years' time around, give or take, about 3,500 charging points across all these fast chargers across the country, right? So there's a fairly healthy and dense distribution network. We at that point in time, the first round of batteries that have gone into field will start coming back after 5 years, 6 years in operation, right? Then there is a second life use case for batteries, whether it's static storage and data centers or solar applications, EPS, and a bunch of other things, right? And then there is a larger sort of a play in storage where we are not just looking at reusing the batteries that are coming back, but going after a much bigger play in fundamentally building batteries for other applications, right? So the play is much bigger, right? And therefore, when you look at business models, we're not looking at a business model saying how much money can I make in a traditional OEM business. What you want to say is that as a full stack solution, where is the profitability coming from, right? And even if I take a limited view of just the scooter business, even not the company business, right? Even within the scooter business, right, there are new things emerging. Today, we're not in a position where we are saying, unlike all traditional OEMs, we don't expect our partners, our retail partners, to make truckloads of money on service and spares. We don't want that, right? From a product development perspective, we are pushing a model where we are minimizing the need for service at all, right? Maybe once in 2 years or something, when something happens, there is no concept of fixed service. We are inching towards there. So we're going fundamentally against what is the traditional model of create service opportunities, because sale mein to jo paisa banega so banega, right? So we are saying, if you want to make money, we'll find other solutions. So there are subscription plans, there are connectivity plans, there is a service plan, there's extended warranty, there's a buyback, and there's a whole bunch of things we're working on. Stuff we had sort of announced but not rolled out yet. Battery as a service. Now, battery as a service in swapping is an obvious use case, but battery as a service in fixed also is a use case. It's just that there's the physically it goes with the vehicle, but the ownership lies with the OEM, right, or somebody else, not with the customer. So I think anyway, whether you take a limited view of the scooter business, or you take a larger view of the automotive business and the energy business, I think we just look at fundamentally very different business models. And this is, somebody had raised the example of mobile phones. So I come from that world. I come from Nokia, and this is like early days of smartphones, where when smartphones came in, you build the fundamental capability of smartphones, the connectivity, etc. And over a period of time, you discovered use cases, that are monetizable, right? So that's the process of discovery that sort of comes in as you go along. But fundamentally, what we built is a connected ecosystem now, right? And that just opens the opportunities today. I can guarantee you, and I put my money on it, right? Like 3 years, 4 years from now, for somebody like us, a very large proportion of our gross margin will come from opportunity today we don't even know, we don't even see, right? And that's the opportunity we're looking at, right? So it's really a very, very different game.
Wonderful. I think you almost, Ravneet, thank you for answering it, but you also threw in a few hints which lead us to the next question, which is related to the economics of any business model in the EV value chain today. And I will probably invite Ketan to answer that question, and then we'll love all of both of you as well to chip in. Ketan, is the economics looking attractive in this EV value chain? And given what Ravneet said, with the new use cases coming in, and hopefully at least some of them are monetizable in future, how will the economics change over the next few years?
The economics, if I talk about, let's say, TCO for two-wheelers especially, the TCO economics already made sense, I think, already a couple of years back. for this category. And now with FAME subsidy and petrol prices going up and all of that, the economics has improved. So yes, for this category, at least I can say at least two-wheelers, three-wheelers, and these kind of categories, it already makes a lot of sense whether you compare with CNG or petrol or any other form of fuel. So yes, the economics already makes a lot of sense, and it is going to make more sense because first the policy is very clear: take from this hand and give it to this other, because you are taxing the petrol and diesels as much as possible, and you are subsidizing the other part. So I think that will continue to go on. And now with the PLI coming in, and the kind of incentives which are being offered under the PLI scheme, that just changes the game altogether. So we're talking about huge incentives being given. The size of the policy is huge, and so the economics will make further more sense as we go forward. And I think the main thing is that to localize the supply chain is very, very important, because as the demand is increasing so much, we don't want to be dependent on a country. Probably we might not have very good relations at some point in future. And so it's very important that we localize the technology, localize the supply chain. And already on the energy generation side, solar, of course, the plans are there, and big investments are being announced. And similarly, on the consumption side, let's say electric mobility and battery storage, I think it's very important that the supply chain is localized, because that's a big risk which we carry when we talk about economics, because almost in electric vehicles, probably 40 to 50% of your cost of the vehicle is a battery. So the key components, the key materials have to be sort of tied up. The manufacturing has to happen locally, so that the external shocks and external factors today, any external news, any external factor affects your economics. So those kind of risks have to be mitigated. So yes, I think the economics looks pretty good currently, and it's supposed to improve, I would say. The only blip which might happen is after the FAME goes out. I think let's see how things happen after that period, and how government sort of comes out with the next sort of set of measures. But I'm sure, I think the policy measures are going to continue in some form.
So are you saying, Ketan, that for OEMs, from OEMs perspective, the economics is already looking good because of the FAME benefits or the other areas you talked about? Can we see it? Let me ask the question in a different way. From a customer perspective, I hear you that on a TCO basis, from customer perspective, we are already there. But from OEM's perspective, is the P&L going to be sustainably profitable in near future?
Ultimately, for next few years, I think we are looking at a demand problem more than a supply issue. So as long as that, if I talk about a short to medium term view, of course, everybody is going to get enough business and enough sort of things. But once the consolidation happens at some point, and it is bound to happen, you cannot sustain an industry, with so many players forever. So once that kind of consolidation happens, I think it is going to depend, on who's going to remain and who's not going to remain. So, but one thing is for sure, that the sector is expanding. There are multiple avenues of revenue which are coming in, and somebody will take one form or the other, maybe energy side, maybe combination, maybe OEM or mobility as a service, whatever. So there are so many business models which are being created. So I think everybody has to find its right place, right space, and what you can do differently to ultimately switch and expedite this transition from traditional to electric mobility. And that's the whole objective, I think, for everyone, to expedite this transition and to help in some form or the manner to enable that. So I think there are so many avenues of business right now that you need to really choose where you want to add value. That's pretty much.
Okay, very good. Ravneet, let me invite you to add to Ketan's answer on this economics, and also add another question to it, whether government is doing enough to make it sustainable, both from demand growth perspective and also from supply economics perspective. Any thoughts from your side on this?
See, the government has been very supportive over the last few years, and in the early days, when days of Fame One, I mean, you could see uh, the pushback from the petrol players, large petrol players, to slow down the adoption of electric vehicles. But the government actually stood firm on their ground, right? And bear in mind manufacturing is a large proportion of our GDP, and within manufacturing, automotive is a very large proportion, right? To be able to stand up to that group of people, I think it took courage, and which I think the government demonstrated amply, right? And then the Fame 2 came in, which changed the game quite dramatically in terms of solving for upfront. TCO was never going to be a problem, but upfront sticker shock was a problem. We solved for that, right? And obviously TCO became better. Then the state government jumped in, and then the whole thing about there's a GST, and then there is a PLI, and a whole bunch of things, right? So I think from what the government can do, quite honestly, I don't think anybody expected government to do as much as they've already have done, right? So full credit to the government on that. Sure, there are some niggles on the PLI side, who gets, who doesn't get. Those are part, but fundamentally it's in the right place, right? I think our biggest risk that we carry in this business today, as an entire industry, is not the risk of demand. I don't think we'll have that problem, right? We see demand growing, and as better products keep coming in, demand will keep growing because costs are sort of coming into control, right? So the issue is today there is very low predictability on the supply chain side. Whether there is the cell side, whether it's electronic side. Now, it seems to be that the electronics will get solved over the next 2 to 3 quarters, right? The way things look like, because it's a problem that impacts everybody in the world across industries. So, the world is all rallying around that. So chances are it will be solved, right? But that's one problem to solve. The other problem we have is on the cell side. Now, we're just struggling to get, the allocations for cells from major players for the entire country, right? Now, those things are coming the way, because right now it's a situation where there is market momentum. There are people who are hungry for products. There is an 8-week waiting period for products, and we have manufacturing capacity which is lying idle because we're not able to produce as much as we are capable of. So unless we solve for that, which is a combination of localization and just securing and building a strong supply chain, once that piece of the puzzle is solved, then I think we are sorted, right? Because demand is solved for the manufacturing capability. There is also a learning curve of manufacturing, product development. I think a lot of companies have gone through that and are going through that. Then there was a problem of, is there adequate choice for customers, with all the big players coming in. I think if you look at the entire jigsaw, all those pieces have been sort of coming together. This is the only one. But unfortunately, this is one of those areas where OEMs individually can't solve their problems. So this needs an active intervention by the government, not just by way of money allocation, which they've done, but it just needs a stronger impetus, right? It needs big players to come in. It needs lobbying by governments to get big players to come in and set up manufacturing here. Like, for example, we talk about semiconductor and chips, right? Like, the issue is China is ahead for a variety of reasons, but also the fact is that anybody produces China has a strong local demand itself. Doesn't mean that like products that are produced there are consumed there, but products that are just produced there, right? So there's such a big local demand that even if they do zero export from there, it still is a very strong sustaining business, right? So I think those things have to be solved for. Cell is a big one to solve for. Once these two are solved, honestly, this will go like a rocket, And having spent some time in this business, there were times where we were sort of almost riding on wishful thinking, saying "Ye to badhne wala hai." But today, you talk to anybody in this ecosystem, anybody, right? Any price point, any kind of category, people are saying, you know what, just give me a stable supply chain. I'm scaling up manufacturing, and then you see me sell. So I think we solve for that. We solve for a long-term future of the industry.
Wonderful, thank you, Ravneet. Before I close the session and summarize at least my key takeaways, Puneet or Ketan, you want to have any last words or thoughts you want to share?
Sure. Just to add to what Ketan and Ravneet said, our business is the fundamental tenet on our business side is the fact that the TCO makes sense. I mean, we were not to start a ride-hailing service if TCO did not make sense. Gone are the days where CNG was at 38 rupees a kg. Now it's nearly 60 rupees a kg. Gone are the days where petrol was about 74 rupees a liter. It's now north of 110 rupees a liter in most parts of India, like Delhi NCR for that matter, or Bombay. And with the current global scenario and what's projected, we believe that the costs are only going to go up. For freight, logistics, ride-hailing services, where assets move more than 100 kilometers a day, maybe 200, 300, 400 kilometers. With every kilometer that you move forward, it makes sense you to go to electric because of your operating costs are super low. So we thought that the best use case today, and maybe for the short term, midterm, will continue to be logistics, delivery, or for that matter, where two-wheelers could be used, largely, and also ride-hailing will be a big beneficiary of this lower cost. The capital cost part, like even Navneet was pointing out, right now is largely dependent on the chip supply shortage or the battery cost. This will eventually go down, like what happened in solar. Ketan and myself are beneficiary of, we saw initially solar power plants at about 15 crores a megawatt. Today, they're nearly about 3 crores a megawatt or lower. So that's eventually going to happen. But the best part is, the good news is that the costs are going to go down. The cost of an ICE and an electric car today will be the same. Today it's like $13,000 for an electric car, about $10,000 for a BS6 ICE. So there's a difference of 25%. But if you see the cost of operations, you have a delta today, massive delta. So, in our business model, if we run electric cars, it costs us about $400 a month. IC, it costs about, CNG based costs about $550. On a petrol diesel car, about $650. So it makes sense today. Will it make sense tomorrow is very, very important. And we believe with our past experience and what we are seeing in the industry, it will definitely make sense tomorrow also. And this is why we think that largely, predominantly, ride-hailing, logistics, delivery will rule the roost for the short-term, mid-term. And like Ravneet pointed out, with better products, better consumer experience, good, solid products, once consumers believe that besides the TCO benefit, there are good products in the market, they will also start buying individual assets at large scale. That will happen post-2025.
Wonderful. Thank you, all three of you. Let me just quickly summarize. Very, very insightful, interesting, and rich session. There are 5 or 6 takeaways I have jotted down, and let me just quickly synthesize, and if you want to add anything to it. Number one, I think I love the way, Ravneet, you described it. It's a rocket which has already taken off and nobody can stop it. So EVs will increase in the Indian market. Of course, there is a phasing of it, or there is a sequence of it, with two-wheelers being ahead of other segments, and there is three-wheelers, and there is buses, and there is PVs. But EVs have arrived, and the penetration will only increase across segments. Number two, on the ESG side and carbon neutrality side, we spend a little bit of time, and I think my takeaway is that yes, EV will contribute. Of course, it will happen over a period of time. It's not going to happen immediately, but EVs will be a major contributor to our ESG and carbon neutrality goals. 3, we talked about the charging infrastructure. And one of you talked about the range anxiety point, which is leading to 80 to 90% of the people not able to decide to buy an EV. It's a chicken and egg problem, as you described. We are on right track. We are doing some initiatives both on the government side and private institution side, but we have a long way to go. And hopefully, as we scale up and we see more EVs on the road, more charging infrastructure will follow. Number 4, we spend time on technology and business models. Wonderful to hear your thoughts on the full stack model and the EV ecosystem. That's the way to go. We heard the 2 different perspectives, one from shared mobility and second from OEM, and then both hinted towards an EV ecosystem play. With several new use cases coming in, like you talked about battery as a service, Ravneet, and then many of them becoming monetizable in near future. 5th, on the economics part, I think at least for a couple of segments like two-wheeler, three-wheeler, from a TCO perspective and from a customer perspective, we are already there. From OEM's perspective, I think one of the things I heard is as the scale-up happens and localization of supply chain happens, the economics will become sustainable with time. And finally, we talked about the government support, and you guys brought in a few other risks. While government has done enough, probably more than what anybody expected to support EVs, but there are other risks in the value chain, be it the chip crisis, which all of us know about, or even the cell manufacturing and the dependence on other countries for batteries. So there is still a need to think through all those issues, because just solving for TCO is not going to be enough. Sooner or later, the supply chain will start cracking up, as we are already seeing. that there's more demand right now in certain segments, but supply is not able to catch up. So those are my takeaways. Hopefully I captured all the key points, but please do add if I missed out anything.
Sure.
No, all good. Yeah, I think you captured really well.
Wonderful. Nice meeting all three of you. Thank you once again for sharing your thoughts. We'll close the session with that. Have a great afternoon and great evening. Bye bye. Take care.
Welcome to ET India Inc Boardroom. I'm Aloni Bhatt. We have a special fireside chat on innovative models addressing climate change, ESG investing, and transition to a low-carbon economy. This is quite a mouthful, but quite simply, it's about innovating and investing to save our planet, to save ourselves, and how well are companies globally managing to do this. Now, we have a very special guest to break this down for us. I'm pleased to welcome François Paoli, Global Managing Partner for Environment, Social and Governance at Bain & Company, which is a global management consulting firm that provides advisory services in strategy, marketing, organization, operations, IT, M&A across all industries. François heads Bain's ESG efforts and advises key consumer goods executives throughout Europe, North America, Asia, and Australia. He joins us from Brussels in Belgium. François, welcome.
Good morning, good afternoon. It's a pleasure to be with you.
François, so let's get started. For a long time, the top goals for companies have been wealth maximization or providing shareholder value. With the focus on ESG, have these changed?
Thanks for the question. It has changed, but it has not disappeared. So we are, and I think for most of us, it's exciting, seeing the transition between a world where it was shareholder capitalism to a world that some call the stakeholder capitalism. So nobody is so far trading off shareholder returns, but everybody is asking company or demanding of companies to add parameters to maximize. So it's the value to shareholders, but it's also the value to a broader community of folks, consumers, employees, and also broader communities. We are in a transition, I said, because the ability for companies to trade off for one for another is not clear yet. And most of the executives I talk to are in this transition phase that they need to provide the ROI they used to while caring for communities. And this is the time we are experimenting right now.
All right. How long do you assume or expect this transition phase to be? And do you see this as being different for different geographies?
No, I think that's you're asking about the timing of this transition. I think it feels that it's, to me, going to be less about the geographies. I can talk about it later, but I feel that the Indian consumer, the Indian investor, and the Indian government is as concerned about ESG as what I see in the United States or Europe. But I think it's by issue that we'll see a difference in timing. There are some issues, and I'll quote two, where we are very close to be extremely clear about what we want. When I say we, it's communities and stakeholders. Carbon gets measured properly. Scope 1, Scope 2, Scope 3, you may have heard of that. Scope 3 is clients and suppliers. And diversity, equity, and inclusions are two issues that are super high up in the concerns of folks, and that gets measured, i.e. targeted, very well nowadays. If you look at the other end of the spectrum of ESG and you ask me about fairness in governance or biodiversity, we are just at the start of figuring out what the stakes are, how to measure them, and I see a much longer transition. Sorry, just to be technical for a moment, biodiversity is a huge issue because humanity is destroying biodiversity at a speed that we've never seen. But the ability to measure the richness of biodiversity is very limited. Even scientists struggle to do that, Amiloni. And so we are going to see a transition. I think it's going to take years. and it's going to depend on the issue we are talking about.
So ESG are evolving rapidly, and they cause highly interconnected externalities. When it comes to untangling this, web of sustainable growth, we find a lot of interdependence among existing systems. For instance, electric cars are only beneficial if you have electricity which is generated through renewable energy sources. Now, what do you see are some of the challenges that come with
this? It's what I started to talk about with biodiversity. There are three challenges. The first challenge is just a candid understanding, right? Some of these fields, like the intricacies of climate change and its effect, I was talking about biodiversity, is not yet well understood. This is science that is moving every day. And I'm glad to see that there are more investments, more research going at this, but it's moving. So that's one complexity. The second complexity is simply how you measure things. You get what you measure is one of the oldest statements in business. We've been measuring profit for 250 years. We have not been measuring ESG for more than a couple of decades, so it will take time. But the third one that you're hinting on is probably the one that will take the most attention, is the way all of this is interconnected. I'll give you a very simple example, is that one of the highest impact thing going on globally is the removal of the Amazonian forest or the tropical forest. Amazonian in Brazil, tropical is in countries like Indonesia. Of course, people don't do that for the workout. They do that because they have no alternative. They do that because they need to make a living. Until you provide a better living to these folks, a transitional agricultural plan, they will continue cutting trees because that's the only way to make a decent living. And so the interconnection between the E of ESG, environment, and the S, the social aspect, is paramount. We are not used as business people, Binoni, to make these connections between stuff. We have been educated to think linearly.
Right.
Linearly means I have an input, I have some value-added process, manufacturing, I have an output, and I have waste. This is how we've been told value chain work. This is how we've been educated at business school. The problem is that nowadays, waste cannot be an afterthought. And growth cannot always come in using more natural resources. So we need to reinvent how we think circularly and how we think connecting these issues together. And we are not yet there in certain sectors. And in some sectors, I see very fast progress, like in fashion, where they are talking about reusing clothes. Yeah. So difficult to understand, difficult to measure. And the biggest challenge will be to think circularly and not linearly.
Companies decide, which one, E, S, or G, needs to be focused on? Do you sometimes feel, though you did say that environment and social is perhaps given a lot of weightage, but governance, perhaps we're not able to move too much on it? But would you say in an emerging economy like India, the S, which is social, may need more weightage because of the social economic deficits that exist?
This is, you're spot on, Miloni. I think that I'm going to talk about maybe India as a whole, and then I'll talk about what every company, in my view, needs to do. I think what we are seeing as emerging insights from the Indian consumers is that there is a real focus on the S, and the S mostly around health. Right. Because at the end, in a market that needs to cater for over 1 billion people with amazingly vibrant population, you need to take care of basic health issues. And so I think you're spot on that if you had to do an average of Indian concerns, which of course we know it's a rich country with much larger than Europe, etc. But if you had to say there is one takeaway, it's more S than E. Now, that's an average statement. Every company, in my view, needs to do the work and go from the plethora of ESG issues, depending on who talks about it. We, Bain, have identified 21, 7E, 7S, 7G. I can provide you with the slide. You need to define urgently what are the 5 that matters to you. For some companies, it's water, because they are heavy consumers of water. For some company, it's fair wages, because they have lots of agricultural folks being their suppliers. And we know that with agriculture come tensions on standards of living. every company needs to do their own work, get that down to a small 5, and decide on which one they will, I wouldn't say play defense, but they will remove negative externalities, remove negative impact they have, but never strive to be positive. When your product is polluting, you try to remove the pollutants, but you don't add value to humanity. For every company, however, there are a handful of these 5, 1 or 2, where you can show positive impact. I think there are lots of companies who can show candidly that they provide better living for their own employees, their own supply chain, the people who grow their materials. The future is into also showing this positive impact on communities.
Right. When it comes to ESG, companies, may be setting out their own goals, and they will say, "Hey, listen, we're on track." Do you think that in most cases, the consumers, the employees, the investors, they are aligned to whatever goals or purpose the company sets out?
Well, there is a straight answer to this, and it's no. No, consumers, investors, and employees are not always aligned with what the company's purpose is. But it will be a shortcut and probably borderline a mistake to consider this that it's the company's fault. So I'm going to just speak briefly about consumers, employees, and investors to give you a sense of the dissonance we are seeing. First of all, consumers, they are not, especially in India, very educated on what sustainability means. Even in the West, by the way, people don't know yet what the most sustainable offering is. So consumer, because they don't know what they want, because they are not also offered the alternative sustainable products, are not clear about what they want. Cause of dissonance number 1. Employees, all the young folks, Miloni, want to work for a more sustainable company today. The data for India is 80%. 80% of 21-year-olds to 30-year-olds say they want to work for a ESG-driven company or sustainable employer. The problem is the middle management. The middle management, why? Because they have both the ESG goals coming from the board and the P&L pressure of delivering the returns. And they are asked to reconcile this in their own terms. Sometimes it works, sometimes it doesn't. So they feel what we call taxed and told. So the middle management sometimes feel squeezed about that. That's cause for dissonance number 2. And then the investors have not yet made up their mind on where they are happy to trade off returns for ESG performance. So 3 causes of dissonance, consumers, employees, and investors, which make most purpose of most companies challenged today more than ever in the past.
François, you spoke about the dissonance when it comes to consumers, and especially you hinted at consumers in India who may not be aware of, what are sustainable goods, packaging. But in India, there is also another problem. For instance, if we look at the consumer trend, consumer sentiment, when it comes to sustainable goods and packaging, they are not widely available and they are expensive, So how do we reconcile this?
No, I think this tension, this paradox is very true in India. So it's not reconciled yet, and you're absolutely right. It is a tension. I'd say the following: what we perceive from Indian consumers now is that they do care today. So it's not something that will eventually happen in the future. The Indian consumer, health first, environment and social a little bit behind, is concerned about ESG issues. But you're right, they don't have the choices yet. They are not educated. They don't find the product. I call this a massive opportunity. So I call this a massive opportunity for the Indian retailers, the Indian consumer goods company, the Indian company, agriculture company, tech companies, to provide them with better choice at more affordable prices. You're probably aware of this, but in consumer products, you have what you call the say-do gap. Consumers say they want more of this product. Consumers say they are prepared to pay. When you look at what they actually do, their ability or propensity to pay is much lower. And it's very human. If you ask me on a Monday how many times I will work out, Miloni, I would probably tell you 5 times. If you ask me on a Sunday how many times I worked out, it's probably down to 2, 1, or sometimes 0. So there is a say-do gap, not just in ESG, everywhere in humanity.
But François, a consumer will always go towards value. Wherever you are getting the best value, that is where the consumer is going to go. I mean, I'm just trying to understand that, for companies to maybe drive to that value, it is a journey. Investors maybe want the company to make the journey faster, but the consumer is also moving at her or his own pace. So again, there is a dissonance.
The dissonance is, I think, the dissonance that will take the longest to take care of is the consumer dissonance, because indeed, consumers are ultimately trading off affordability, availability, and value. Now, the best companies at this are helping consumers redefine what value is. And let me just explain for a minute. It's really Maslow, the Maslow pyramid has defined a series of values for us humans. The best companies are just moving from the basic of what the product does, clean, quality, safe, affordable, to something of a higher element of value, something that makes me as a consumer move from what is the product doing technically to what does it do to me and my community. Yeah. And we have tangible evidence that the winning companies in ESG are helping consumers redefining value and bring value that is higher up in the pyramid, i.e., helping me feel better in my community.
So yes, there is growing realization world over and I think that is with everyone, that we need to be more climate friendly. We need to be more conscious when it comes to doing business. Companies are under pressure to adapt. But what are the pushes and the pulls that you see from your vantage? Are CEOs able to adapt?
This is the challenge number one of CEOs today, is that we've seen everywhere in the world, and I know India was very hardly hit by the pandemics. The problem is that CEOs today need to adapt at a speed that they have never seen before. And a lot has been written, Miloni, around the ability to predict the future. I think by now you and I know that this ability was never very strong, but has disappeared. We have not seen any of the crises that we are experimenting now coming. The second one is people talk about resiliency. The problem of resiliency is that it ends up being buffer capacity everywhere, and it's not providing to be very economical. The real deal is to be adaptable. Most CEOs today will say they are not agile enough, they are not fast enough, and we have a panel of about 2,500 CEOs. The number one takeaway from the pandemic is the issue of I'm not adapting myself fast enough. This gives me, by the way, a lot of hope, because I don't know India nearly enough, but I've been a great admirer of the Indian entrepreneurship wave the last, I'd say, decade. If there is one country that can adapt faster because of its entrepreneurial skills and agility, it's India. I think this will be an opportunity for Indian companies. I'm convinced of that.
All right, so that's a huge takeaway for a lot of companies in India. How is ESG strategy for companies paving the way for innovation? Yes, we've seen it in India. So I'd like to give you an example. For instance, a lot of companies, that were perhaps making some kind of material, fabric, they quickly pivoted, and they ended up, making those sterile suits, masks, and stuff like that. So yes, we have, an example of innovation here in India. But can you give us, more of an idea on how the strategy is making way for innovation?
No, but as I was saying, I think there is an element for every company of understanding what the negative externalities are and making sure the negative impact on communities is managed and decreases over time. But by far, what I see in ESG is very close to being a new industrial revolution, i.e. a need to completely reinvent businesses. And let me be concrete on two elements. One, I talked already about, which is the need to create circular models, circular businesses. I think there is an infinite amount of opportunities for businesses in the product area, but in the service area, to tap into this waste that we need to take care of to create new businesses. I see this in fashion. I see this in, you and I only use our car about 1 or 2% of its available time. Most of the time, a car sits idle on the parking space. People like Uber and others are using this spare capacity to make circular businesses. I see infinite amount of innovation coming from this circularity. The other one is technology. We know, and it was again very vivid in the report from the UN on climate change last week, we will need to come up with new technologies to manage the ESG challenge we have. I see an infinite amount of opportunities for companies to innovate into these new technologies. And of course, when you think technology, you immediately think batteries, electric car, or new type of fuel. There is also a massive amount of innovation going on in food, in the food system, reinventing proteins. As you know, you can't continue with milk and beef the way we have done. Insect proteins, for example, just that is a massive field for innovation. I'm very hopeful that around circularity and around new technologies, many companies will be able to accelerate growth.
François, do you see a time when ESG is so integrated into the DNA of a company's business strategy that brands will not have to really point at it as a special commitment or a goal?
To me, to be honest, that's the only way I see. Because at the moment, I see that unfortunately for 80% of companies, ESG is still something on the side. And I mean no disrespect, because it's new and I made a point, it was difficult to understand, measure. So I understand why, but we will need to integrate it in the core of the company, because we need to reconcile ESG consideration and growth considerations. Until it's done, we will always have dissonance in companies. The future is when brands will talk about the way they deliver value, and this value will integrate value as value for money, value as quality, and ESG consideration. I see this as the only way.
Right. So really ESG is a journey, isn't it? And it's non-negotiable for companies, because at the end of the day, our survival really depends upon it.
It's a non-negotiable. It's our survival. I don't know when shareholders will adjust. I know that employees and young generation have adjusted already. I see this at Bain & Company. We have 15,000 employees, which makes us a decent sized company. Everybody we recruit, 21, 22, 23-year-old, want to do more ESG and want to have impact. I think the ship has sailed. We need to do this now, because is it consumers, is it employee, or is it shareholders? I don't know who's going to call it first, but if we bluff, our bluff will be called very, very soon.
Right. And, hopefully with everyone's efforts, we'll have a better chance of building a more inclusive, equitable, and a more sustainable world. François, thank you so very much for your thoughts and for your insights today.
It was a pleasure meeting you. Thank you very much.
Hope you enjoyed all the sessions at ET India Inc Boardroom today. The big takeaway today is that financial outcomes alone are no longer the only metric of success in business now. ESG is equally important. But while ESG is gaining momentum, it is still an evolving landscape, which makes it difficult to assess, implement, and manage programs in an organization. But that's it from all of us today. Check out our website, economictimes.com, for more information. From me, Maloni Bhatt, and the rest of the team here at ET India Inc Boardroom, goodbye.